All right. Good morning, everybody. So it's one of those really weird mornings where there's not necessarily a whole lot going on, but there is a whole lot going on. There's a little bit of a meltdown going on in the crypto space. And that kind of ties into how it was leveraged and what was done with it, right? When it was used for collateral to finance other things, and now that collateral comes due, it's almost like what was going on over in Europe, right? When they were using these funds as collateral, and then they would buy more of the same funds, and then they would use that as collateral, and then they would buy more of the same funds and use that as collateral. Well, if what those funds are focused on collapse and you get a margin call, where are you supposed to get capital when the collateral that you were using to purchase things is devalued so much that it doesn't have any collateral, it doesn't have any value? So this situation going on in the Bitcoin space, it's not just some Bitcoin thing that we can just shrug off and say, oh, well, it's that crazy Bitcoin stuff. It has far-reaching implications. Don't exactly know where it's all going to go. The other side of what's going on is what is happening in the FX markets. Japan yesterday, for an example, had a lot to do with the crazy moves that we saw in the S&P and the NASDAQ. And I did my best to throw out some analysis. I just used Twitter for that. Kind of seemed like the easiest medium to use to kind of reach everybody and help people kind of steer clear of the chaos, but I don't think it's done yet. We do have CPI tomorrow. It's the biggest thing on the list. We got crude inventories today at 10:30, which we normally do, right? That's not something new. And we have additional auctions at 1 o'clock. That's going to be a big one. We got the Bank of England speaking today. We got the United States Fed speaking today. So, we got a lot of people out there chipping their teeth. We'll see what comes out of it. We're not really expecting anything on the US side. I never try to anticipate what Bank of England is going to say. It's just a different wheelhouse, right? I can't seem to put my mind in I can't fill those shoes. It turns out, not much of a surprise, that the elections were not a massive blowout for one side or the other. And I mean, that's pretty much par for the course. We don't normally see one side dominate. There's just too many angles, right? Hopefully everybody got to vote, by the way. My own little input to that. Participate, whether you think that your voice matters or not, right? Go vote. Too late now. Do it next time. Okay, with Disney taking that gut punch yesterday, it is going to directly affect the Dow Jones. The Dow is a different index compared to, say, the NASDAQ and the S&P. There are price weighted indexes, and then there are market cap weighted indexes, right? So Yeah, it's going to feel Disney today. Seeing that Goldman put out a call out on US dollar Japan to 155. Seems like they're a little behind the curve. The call out has been to 151 and then to 155 for a while now. Glad to see that they decided to get on board. All right, and for the February meeting, it's the only one that really seems to have much change in the last week. Nothing beyond what we were really talking about yesterday. So it's still, we need that CPI data, really. It's what it comes down to. All right, so the trend line is holding. We did pull back significantly to that 38.50 yesterday. As I mentioned, a few Mondays ago, that big green candle was a Friday that closed. Said that's it, we're done, roll it over. And we had that nice little sell off to the 50% mark. Got a nice little bounce there. But in the bounce, it needs to, not go too far. Too much of a pullback becomes detrimental to the cause. Generally speaking, a line in the sand of around 50% is what we want to focus on. And it's not just the idea that we got through the 50%, it's closing above it, right? So we got through that 50% mark. Is a little bit of a concern, but we did manage to come back down below it. So now we're just expecting that rollover and continuation lower. For a little bit of perspective of how CPI can affect our market, remember, we're in the environment right now where bad is good and good is bad, right? So we had bad CPI, and the market responded from that. It wasn't all done in a day, but from the announcement until the curve ended, we made about 11%. So depending on how CPI goes tomorrow, we could make a run back towards this 4,100 area. In the form of technical analysis, as long as we don't get above that, we should be okay, right? The prevailing structure would hold true. If we get above and close above 4,100, I'd say on the weekly, then it breaks the technical trend, almost like August did, right? August should not have gotten above this pivot point back here. Shoulda, woulda, coulda, it did. So, we had to deal with it, but we shouldn't get above 4,100. And if we do, it's certainly not above 43. And if you're thinking, why the hell does it matter? It's so far away. Yeah, but if you're running, if you got puts and calls sold naked on the ES and the MES, which is a really great way to go, then, having the fortitude to hang on when, say you're short 4,400 calls and you got price running at you to 41 and 4,200, and still hanging on to it. Same thing with the downside. If you still got those puts from around 3,400, when we make those moves down, and kind of gets a little freaky. The point of this chart, though, is to remind you that when CPI comes out tomorrow, it very likely could be an extreme situation. Just as big and just as extreme as an FOMC announcement. You could say that it's a Busby. When it comes to daily and weekly timeframes, patterns like head and shoulders and Busbys and wedges, and I don't really like using them out there other than just maybe for context because of how long it takes for them to unfold, and but yeah, I mean, it absolutely could. It's not a study. I used a drawing tool and I drew them by hand. So all you have to do is go to Google and get those dates and use your drawing tool, this one right there, and draw them in. And I know, I get it. Everybody says, oh my God, that sounds like work. You mean I got to sit there with a drawing tool and draw every one of those lines? Yep. But when you automate the process with an indicator, you're not looking at a chart. You don't notice that there might be a Busby there or a head and shoulders or an outsized candle that needs to be reevaluated. When you automate the system, you disassociate yourself from the charts and then you miss shit. It's the easiest way to say it. You're so much better doing the work manually, even if it takes you a week to build that chart, because along the way, you will learn a whole lot about what happens during that CPI process and FOMC and all the rest. I did build an indicator for it at one point. You'll probably find it in the Discord. It's not necessarily for the FOMC. It's just an indicator that you can put in the date and you can put in what you want the words to say, and it will draw a line at that location with the words that you want, right? And then there's another indicator in there that you can tell it if it's this day, draw this line kind of thing. So it would do those. I don't know if that's much better. Volume is in line today. It's really all we need to see, that it's not crazy low and it's not crazy high. And then we just turn that thing off. $1 today, the 10-year auction. The 10 is not one of the golden ones, I guess. I don't know. I need a better word for it. It's not one of the babies, the classics, but it is certainly one worth watching. So $1 today, don't sleep on that. And it's the only one we got for the afternoon. Yeah, the charts are shareable, right? So with the XPX chart with all of my lines on it, it is a shareable document. All I got to do is share the link. And again, that wouldn't be any better than the indicator itself. It's just somebody doing all the work for you and giving it to you. So yes, I can share it. I'll put it in the Discord. You guys can have it. Why do any work at all when somebody else can do the work for you? EIA report, 10:30. Additional auctions at 1 o'clock. If you're going to do a 0-day today, be very cautious at 1 o'clock. Once you're past that, and it can take a good 15 minutes for anything to kind of reverberate through, should be good to go. Yesterday was a little bit of a seesaw, back and forth and then back again. Oh, I know. 20 years in the oil field. My attitude rings bells, right? Reversal off that low. I was done by then. I had already closed out the rest of my contracts, called it a day, gave everybody the heads up that I wouldn't be giving any more call outs. I went and voted and then went and got ice cream and did some running around. And so I didn't give the call out on that last rally back up. By the time I got cell service again, because I live in the country and kind of go through blank spots where there's no signal, we went from going down and we were just passing the cog line at 3,800 to the next time I had signal, we were back above 3820 something. So another whiplash. When it gets around 3 o'clock, I would have expected that kind of behavior because we would have had, the dollar close, the bonds close. It was a little bit of a surprise to catch it at 2:30 in the afternoon like that. It was really just a bit of a surprise, honestly. I didn't expect that one, but I wasn't watching it at that point either. For anybody that was still in the game that late yesterday, you had to kind of wonder, what did we hit? Which is kind of the question I used to ask all the time when I was new and I would see price just randomly turn around and go the other direction. What did we hit? And I haven't looked this morning to see what we hit, but the first thing that comes to mind is a pivot point, and or secondly, that we hit a major moving average. So on your own, if you're ever curious about, a move like that, where it just doesn't seem to line up with any of your automatic visuals, any very obvious pivot points, start turning on different moving averages until you find the one that it hit. It seems a bit arbitrary and a little random, but you'd be surprised at how often it'd be the same moving average that causes that kind of reaction. It doesn't have to be something that this market hit either. We're looking at the ES, but it could have been Apple that hit a pivot, right? It could have been Tesla that hit a pivot. If some other market substantially reverberated throughout the marketplace and bounced off of a pivot and started running to the upside, then that rising tide lifts all boats, right? The moves that we were seeing yesterday were mostly coming from US dollar Japan and its influence on the dollar itself. And then the dollar was influencing the ES and the NASDAQ. So we had that significant sell-off in US dollar Japan. And I mean, just look at those moves in the dollar. So 145 is the line in the sand that we've been using on US dollar Japan. It needs to kind of hold that level, which was part of the call out that I used to recognize we were probably done when we got up into that 3850, 3855 area. Because when the ES got into that area, or the SPX, US dollar Japan got really close to that 145 area. So it was like, sure, we could overshoot, go a little bit more, but not a whole lot more. We had that basing pattern start to form in the dollar. The basing patterns start to form in US dollar Japan. And if you think it through, I mean, if we look at it, US dollar Japan didn't have to rally again. All they had to do was quit falling. Right? I mean, that was it, really. It just had to just stop falling. So we're seeing a little bit of rebound in the dollar, stronger than the rebound in US dollar Japan. I don't think it's done with that 145 area. It might try it one more time. If depending on how CPI goes tomorrow, the move that we see in the dollar might affect US dollar Japan instead of vice versa, right? Instead of US dollar Japan pushing the dollar around. So CPI comes out, say it's really bad news, we start ripping to the upside, and we see the dollar drop below, say 108. The rally in the S&P and the NASDAQ will be magnificent. You see the dollar dip below 108. We'd very likely start getting into that 4,000, 4,100 area, right? And it won't be a straight shot. You know what I mean? Like it's not, we hope it's not going to be a straight shot. That'd be too violent. So we're using the pair with US dollar Japan only because it was a part of the process of what was happening yesterday. It shouldn't be, or we don't want it to be, a daily tool or indicator that we want to use, right? It was what was going on. So we were keeping an eye on it, using it as a part of what was happening. But at some point it will become irrelevant again, and we'll quit watching it as closely. For today, we're still expecting a whole lot of hold the line, right? A whole lot of nothing. We may wick to the upside or the downside outside of the box, a little higher or a little lower. And it wouldn't be a surprise if we did that, right? It's just, we're expecting to hold the line. We really need more information. We need that CPI print. And then from there, I already showed you what the violence would look like. We're going to be, breaking hard to the upside significantly or down significantly. I really can't see, although we have to mention it, I can't see a path where we get CPI and we just hang out and chill. I know it's possible. We never want to say price can't do something. And the CPI could be so convoluted and muddy that they have to sit on their hands and get a hold of the nerds and figure out what to do with it. There's a lot of different CPI, right? And there's a lot of different ways that you can play the numbers. You can look at just the sticky side, pulling out food and energy. You can leave food and energy in. You can look at, at housing. There's all these different metrics that can be fiddled with. But for the most part, it should be a very binary situation where we go really high, really fast, or really low, really fast. When it comes to second and third languages, by the way, when I was studying psychology, they said people that know how to speak more than one language can approach problem solving from different dimensions, from different aspects and points of view. It's one of the reasons that we like to teach children when they're in school more than one language. It helps them in problem solving and all kinds of things. So it's a good thing to speak more than one language. Hadn't really thought about it from that point of view until I got into psychology courses, but there you go. So when you get into hiring practices and they are using one of the criteria for hiring someone is that they speak more than one language, it's not always so that they can speak to a customer in another language. It's because they're good at problem solving, very likely. Or better at problem solving. All right, so we draw the box. If we're going to stay inside the zone, the recommendation would be to break this down into a number of zones. And I would start with the high of yesterday and the high of the Globex. Make that one zone all by itself. And then the high of the Globex to the cash open, that would be another zone from the cash open down to the low of yesterday. And that would be your third zone. You could make it 4 zones. I'm not really opposed to that. Using the Globex open and the cash open for one of those zones seems a little narrow. Maybe down to Globex. And then just one little zone down there at the bottom. Me, I'd rather have just the 3. So, when it comes to zones, it's a bit arbitrary. You can pick and choose. 2 zones would get it done, from Globex open down to cash low, and from Globex or cash open, I mean. So from the cash open of yesterday down and the cash open of yesterday up, those 2 zones would be more than enough. But if you want to break it down more and have, more opportunities to trade, then you could focus on the 3. Within each one of those zones, you can map it out with pivot points, maybe kick it up into a higher time frame, like a 30-minute or a 1 hour, and then look for big candles to measure wicks, pivot points, any kind of structure from that higher time frame. So the end goal would be, if you can get 1 or 2 really good trades, high conviction trades that you can size up your position, right? We only need 6 or 7 points, because if we're holding 10 contracts, 6 or 7 points, we're day done, right? But if you don't have a lot of conviction and you have to keep nickel and diming everything with 1 or 2 contracts, you're there all day looking for another trade, another trade, another trade, another trade, another trade. I don't really appreciate days where we are stuck in the middle like this. It ends up being, very often a lot of chop and lower conviction plays, odd, quick reversals, big candle sweeps. It just becomes difficult to trade, right? I don't need the stress. There's something else to trade. There's always something better, cleaner, that we got an opportunity to trade. So if we stick the range today, like I'm thinking we will, I probably won't be participating much in it anyways. It might be a great day for an iron condor. A 0-day iron. Should have stayed there for a minute. All right, we don't have any big gaps that need to be filled in our area. So there's no gravity. Nothing like that to be concerned with. We want to see how we open today, of course, but using something like a double diagonal would be a little better than an iron. Price wise, you get a lot more money. It'll allow you to put the break evens farther away. I know double diagonals aren't necessarily as popular as, butterflies and iron condors, but when we were running the automatic iron condor strategy before COVID hit, things were just like clockwork. It was just beautiful. It was awesome. Then COVID and the boxes got really wide. We couldn't really run the mechanical irons anymore because it set our break evens too far away, right? The weekly expected move just became so big that there wasn't any money along those edges where we were putting our spread, and everything was mechanical. We didn't get to choose where the spread break even was. We had to target the lines. So when I was looking for a solution to that problem, I came across the idea that double diagonals, if built targeting the area that you want, gives you a really wide box that price needs to stay inside of. And as long as it stays inside that box, you're going to win. That's all it comes down to, right? And the size of the box can be significantly bigger than what we could do with an iron condor. And there's more money in it. Iron condors suck when it comes to getting profit when you build them that wide, that big. So something to consider today would be double diagonals on the expectation that for one more day, this market is going to wait with bated breath, waiting for that CPI. I find it very hard to imagine today that we're going to get beyond 39 and 37. And I know that might seem like a really big range, but when you're using the SPX, you can get pretty wide and still get a lot of money. Now, if you wanted to tighten that up in the later part of today, say after the 10-year auction, then you could put on your afternoon 0-day with a much tighter range. But we're talking about just, starting the morning and not even looking twice at what price is doing and building a double diagonal. Doesn't necessarily have to be this wide. I'm kind of exaggerating a little bit, but I bet you could go that wide and still find money in it. The good thing is if you play it correctly, you could close the short legs by the end of today because they would be expiring today anyways. But you could keep the longs because they would be, depending on which longs you picked, expiring tomorrow or on Friday. That's the way a diagonal works, right? You use two different calendar dates. So then you would basically have a strangle or a straddle after you closed the front end, the short legs. And if you got enough money today from the shorts that you sold and closed, you close those with profit, it finances, takes all the risk out of carrying a strangle or a straddle for the rest of the week. All right, 10-day, 30-minute volume profile. We are still inside the box. We did get up around the point of control, struggled to get through it, and we couldn't keep it. There's a lot of trash to the upside. Getting back through all of this is going to be difficult. Sure, it's a little shallow, but not very much. It's just mainly just a lot of resistance, a lot of trash to get through. And yet the downside is really a wide open, a little bit of support around 37.80, but other than that, there's not much down there. So maybe today that's not going to be very important, but tomorrow, if we do start heading down, there's not a whole lot to catch us. But if we start heading up, there's still a lot of resistance to get through. We hit that VPOC, and the first touch play was there. It did offer a little bit. I mean, it wasn't great, but that's 6 points, and high conviction trade was 6 points. Say 5 contracts, 6 points. Day done. So we don't need that VPOC anymore. We take it off. Yesterday, We can't carry the point of control into today because it already been hit multiple times. We still have the one to the downside at 37.90. And we still have the one at 4,000 overhead. You see this pivot point that's been on my chart for quite a while. It's an old FOMC, and I'm pretty sure it's hard to see in the video, but it's because I faded that line so that if I looked really hard, I could see it, but otherwise it wouldn't be like all in my face right there all the time, right? You can make the lines on Thinkorswim transparent. And that's what I did here. I just changed the transparency so that it was not so easy to see. It's what we came into contact yesterday when we bounced and made that run back up. Remember what I was talking about earlier, when price just stops and turns around and starts going the other direction, and you got to ask, what the heck did we hit? Pivot point. Now, hitting a pivot point and bouncing a little bit makes perfect sense. That's what we did over here with the VPOC. We hit it, we bounced off of it a little ways, and then we continued through the morning. This bounce wasn't just like, oh, wow, it hit that pivot and bounce. It hit a pivot, bounce, and just kept on going in a very extreme way. So it wasn't because of that pivot. I just want to point that out, right? It looks really cool to turn on the chart and see a line and say, oh, yeah, look, it hit my pivot. It was more to it than that. Sure, it turned at that pivot point, but something else fueled the run. US dollar Japan breaking to the upside, back above 146 now, aggressively, and pushing the S&P down. Nice liquidation break. So we're getting a little bit of sassiness out of US dollar Japan this morning. That is a classic breakout. Let's see what we get. All right, we are back above the 10-week, not by very much, just really, I mean, it's a tenuous situation. This is a weekly measurement, so it really does matter where we close on the week. The fact that we're above the 10 right now doesn't hold much weight because there's still a lot of left to this week. Let's flip this study over and point it to a daily. And you can see that, yep, we're above the 10. Again, not by very much. You'll notice that there are periods where we kind of just crisscross back and forth through the zero zone a lot. And then we kind of stick it and we run, you know, a good long ways, have a week or two where we're actually keeping a direction and just making a nice clean move. So right now we're in that transition period. We're just kind of crisscrossing back and forth. We'd want it to give us a little more structure, right? But it's all CPI. At the end of the day, it's what it all comes down to. CPI and right now US dollar Japan. With the election results not yet tallied and complete, you still got to approach with caution the crude or the energy play. This trade got so crowded, and it seemed like everywhere I went, there was just more and more people trying to find a way to get into this trade, thinking the energy was just going to make this phenomenal, beautiful move to the upside. And the more I heard that, the more I wanted to short this thing. USO would be a good way to do it. And you can use XLE, except that if you look at the chart on USO here, and then you look at the chart on XLE, they're not the same. Not even close to being the same. And that's because they're not the same things. The energy ETF only has a little bit of oil in it. It has a lot of everything else. So as you can see, it's made up of a lot of different things. If you look at something like Bank of America, JP Morgan, Wells Fargo, notice how all those charts look really similar. They're in the same yearly formation, same candle pattern, same. I mean, minor differences, but otherwise they're exactly the same thing. XLE does not look like USO because they're completely different things. So in energy, there's a trade strategy called the 52-week high or new 52-week highs. I didn't make it. It's not mine. I think it was covered really well in the book Hit and Run Trading, and that book is in the Bullish Bears Discord. You could also go to the website Swing Trade Bot, and whether you have an account doesn't matter, because even if you're not signed in and you're just on the free account, if you go to research, end of day scans, look at all scans, just look at the name and keep scrolling down. It should be in there, something about a 52-week high or new highs. Yeah, there it is, new 52-week highs. There's a strategy connected to it, right? So kind of, it's a free account, or, I'm not logged in, so there's advertising and all that. Nope, this isn't the one that has the, they don't have a strategy with it. So it's not from this site. Must have been from somewhere else. Anyways, the idea would be that you look for a new 52-week high and then a pullback, and the pullback should last for like a week, maybe a week and a half. And during that week and a half process, every day you set an entry to go long 2 cents higher than whatever the highest price was in that breakout. Right? So say today or tomorrow we get to $94 exactly, and then we fall off, we fall back. Every day you would set an entry trigger at $94.02. And if we don't get there by, say, 10:30 every day, you take the order off, and then you try it again tomorrow, and you try it again tomorrow, and then you try it again tomorrow, and do that for 2 weeks. Unless it just dumps, then obviously you give up and you don't put the order there anymore. And the reason behind the strategy's logic is what happens with price when we get to an area, say like back here when it was a 52-week high. We set a new 52-week high, we pull back from it, challenge it a few times. This one, it actually set another 52-week high, pulled back again, but then it finally did take off. I could have swore that strategy was in Hit and Run Trading, but obviously it's not. I'll have to go look through my notes and see where that strategy came from. Either way, it's not mine. I don't want to take credit for it. And it's very basic. There's not much to it. I believe that I made a how-to on that. It should be on the Bullish Bears website in the next level library. It won't be under options, though. It'll be under like swing trades, because it's a swing trade strategy. You could do it with options, but it was designed for stock. So just check there. I think should be a number of them, right? Like Bollinger Band breakouts, 52-week highs. I put in a number of simple, effective swing trade strategies on there. But what I like about that strategy is if we already have the expectation that we're going to pop up and then fade back, like fake breakout, fast failure, then in the short duration, you could take the market down, right? Call credit spread to finance a put or something like that. It would be a short duration trade, so I wouldn't go out, say, more than 2 weeks or 10 days, something like that. And you are standing in front of a bus, with the elections not yet decided, or it's not tallied yet. We don't have clear results. Might want to wait for the election to get done. So getting a little bit of a rebound this morning. Yeah, it is a little bit like the Darvis box on the activation of, right? Like when you come out of the Darvis and it triggers the play. So it has the same kind of logic as that. I think Tesla's getting a little bit of a rebound this morning, but it doesn't seem to be sticking. So a nice little pop up. It's not holding. There's so much drama going on right now. And the guy is like a drama magnet, right? I mean, he was getting in trouble all the time back in 2018 when he was using Twitter and saying things that were getting him in trouble. Now he owns the place and still causing drama. Longer term on the swing for Tesla, it's still short, right? This is still a really great name to be short in, but it's not going to be an easy name to short. It's certainly not going to be an easy ride. It's going to be a fight the whole way. But when we think about what has not yet fallen and what has plenty of room to fall, oh boy, this is like one of the top names on the list. We want to run it down like how Meta looks, or PayPal, or Roku. This is the kind of destruction that we want to see, right? And it's very likely some of the destruction that we're going to get. And it's just started. So this is a great swing, but it's going to be a fight, because this is one of the beloved darlings. There's a lot of believers, right? Almost cult-like followers. So it's going to be a hard one to run. Just like Microsoft, this has been a solid short, but it's been a hard one to be short. This thing pops up all the time. It seems to go against you a lot. Google's another one. I carried Google short for nearly 3 weeks. And for a long time in that 3 weeks, I was in a losing trade. Constantly. The option price itself just was not giving me profit. And I didn't even start to see any profit until we got below the break even. Normally, when you're in an options trade, as long as it's moving in the right direction, you start to see profit. Right? It might not be very much profit, but you start to see something. And my puts in this thing, until we got past my break even, I didn't see any profit. So Tesla is still a good short. Apple is still a good short. Those two have not yet broke and offer the the most meat on the bone, right? When we think about how much farther we have to go in this market, but they're going to be difficult to trade. At least right now, Apple has that nice little pop to the upside this week. We came up off of that line. And I don't like to short from the lows, so I like the idea that I can get in after it's popped up. Now we've got CPI on deck. As long as we stay below, that, call it 57, then this is still just a great short. The closer you can get into 57 to go short, the better. If we get above 57, then all bets are off. I would wait, because that's a critical level it should not get above. But as close as you can to that for a new short would be amazing. If not, then when we break below that trend line, that would be a great place to get in short. I mean, you don't have to wait for either one of those. You could just get in short, but I mean, there's not much structure to that, right? For Tesla, the same thing. It should not get back above, call it 38. If it does, you got to kind of be a little bit concerned about why is it, it shouldn't go up that high. 238 is also the gap close, so it kind of works perfectly. I know it's uncomfortable to take such a solid name that still looks this healthy in a short trade. I get it. It just doesn't feel good. And it's going to continue to make those moves to the upside. So if you're short in this, it's going to challenge you and it's not going to feel good. But those two are the best shorts out there right now. NVIDIA had that nice run to the upside. Still got to be cautious of this because there's earnings, right? But we've got that trend line breakover. We've got that move to the upside, and it's sell the rip, not buy the dip, right? So it rips, you sell it, rips, you sell it. Well, we're in the rip. I would still wait for earnings because there's just no reason to step in front of those things. Let it report, see how good or how bad it is. And with this one, it's a lot farther away. So I'll say it, but it's not really helpful. It needs to stay below 195. I mean, that doesn't really help very much, right? Now when we're sitting at 150. But hey, I said it anyways. Consider it from this point of view. We're in the middle. And we don't diddle in the middle. Right? So it really needs to have its earnings, resolve the situation. And we're either going to test that 188, 189, 190 area from an earnings announcement, or we're just going to capitulate, roll over, and start heading back down again. My target on this is still 70, so plenty of room to the downside. It's a 50% haircut from our current location at least. There could be some left on Microsoft. It's such a hard one to trade, though, and it's so well beloved. It's in every fund out there that unless we start getting funds just throwing up their hands and puking through redemptions, I mean, I just can't see a path to this, getting down to that 150 area. But I do think we can get below 200. It's just Microsoft's a hard one to short. There's been a lot of talk about Meta has taken the beat down and it's time to buy. That's not true. It's not time to buy. Don't do it. It only feels like it because of how far it's fallen. We have this false idea that, oh, it's got to go up now. Man, there was an article that came out the other day that said that they've got like 87,000 employees. even now, after all of this, they haven't even started doing cost cutting yet. They ain't done yet. They got a long ways to go. So I'd be really cautious there. So the question on how far, Apple, Tesla, Microsoft, short. The time frame that I've been looking at, and this was corroborated by somebody else, is March. I was already looking at March because of the contracts, right? If you go and look at the SPX and you look at, well, I was just looking at the SPX for this. The January and the March options look good. January looks the best, but I want more time than January. So January or March, either one of those would be great for this discussion here with Tesla, Microsoft, Apple, Nvidia. That's a good time frame. If you go past March, the options really start to turn to poo. They're not really good out there. It's doable, but look at the metrics that we use in options, right? Open interest, liquidity, bid-ask spread, implied volatility. The metrics just look like junk. You get past March, it's just all downhill. So, and then of course you get too close, right? Like November is just too close. December, I hate getting contracts for December. You have all of the short holiday weeks. You've got end of year manipulations. Just the options Greeks in December are always trash. They're okay for day trades. They're okay for end of week swing trades. But beyond that, say once we get past July and August and we're looking towards our swings, I always skip December if I can, and I'll either use November or I go right into January, because December's options are just no bueno. So I know we're kind of on a tangent, just poking around in different spots, but it's mainly because it's CPI tomorrow, and there's really not a whole lot that we can structure until we get that data point. So at the very least, we can take a look at what's out there worthy of an opportunity to trade, right? And that way, when we do get the CPI report and the market does open tomorrow, and of course, we're going to have a morning briefing tomorrow, but when we open tomorrow, then we'll have a really clear idea of what we wanted to trade. Because you could spend all day today considering, if we go to the upside, what would you like to trade in that upside move? What's been beaten down quite a bit that could make a nice rally? And tomorrow, if we do start going down, what would you want to jump on for a ride to that downside? I wouldn't want to jump into, say, Facebook for a move down. It's already taken the beat down. I would want, Apple or Tesla, even maybe Nvidia. I just don't like that earnings sitting there. Man, that move in the dollar tied with the US dollar Japan is just crazy. And the only thing that's giving me even a little bit of hope is that we're not reciprocating equally. So you can see what I mentioned a little bit ago, that structural breakout, US dollar Japan on the move, dollar on the move. And sure, I mean, we sold off from that, but we're coming into structure here in the S&P. It is, what's the phrase? It is the reason for the season. There you go. So many great phrases out there. That's not mine, by the way. I didn't come up with that one. All right, so the target is 151 plus. And if you don't want to trade the US dollar Japan, say you don't have a Forex currency account or something like that, you can trade the ETF. So FXI. Nope, FXY. There you go. FXY. It's not open yet, but it doesn't have weeklies. It's not the most glamorous of options out there. A little bit of a spread, about 35 cents. But this would be one way to get into that market. There's also EW something. EWJ. So these should move inverse of whatever the pair is doing. Right now, the pair is making a rip to the upside. You would want to short EWJ or FXY. So US dollar Japan went down yesterday, so the ETF went up. Big gap up. Beautiful for an island reversal to short that sucker like it did back here with that big gap up and then a nice short to the downside. You can trade the dollar too, but every time I trade the UUP, I get assigned, so I quit trading it here. I use the Smalls exchange with Tastyworks. That is a great way to trade the dollar and not have to worry about getting assigned from UUP. So the benchmark and the metric that we built over the last few days still holds true. We want to see the dollar maintain above 110 on the weekly close. The move that we're seeing right now put us back above 110. We are there right now, but it needs to stick. It's got to hold. If we hold above 110, we don't expect the S&P and the NASDAQ to break out and get above that 4,000 level. So this is like a ceiling to that. If we break below 110 and close below 110 on the dollar on the week, then it removes a lot of the overhead restrictions in the S&P and the NASDAQ, and we could leg up into the 4,000 area. If the dollar continues advancing this morning and through the rest of the week, and we start pressing against 113, 114, we're going to look for the S&P and the NASDAQ to break down into a new leg lower. So that would be breaking last week's low. Call it that 3,700 area. We would look to see the S&P get below 3,700 if the dollar gets above, say, 113, 114. End of year in the dollar, we're still looking at 120. But we don't want to get to 120 too fast. If the dollar goes above 115, things are going to start to break. If it goes to 120 really fast, things are going to break. So it's still the target, but we need it to get there slowly, casually. $147.65 for US dollar Japan is a level of resistance. So if we get an inside week breakout, that's the level of concern. If we get past that, magnet to 148.74. That's a monthly level of concern. With the euro US dollar, see if we watch this, see if we get back below parity. And with the British pound US dollar, we're going to look for this to get back down to around that 113. But even just today, getting back below 1.14 would be a lot of work. The US dollar Canada is going to be directly affected or connected with anything in oil, so /CL or USO. We're seeing the rally in the CAD. We're not seeing the rally yet in oil, other than we've got that nice wick along the lows here. So we need to get that turned back around. Oil's volatility is still outside of the box. Bond volatility is still underneath the trend line. We have stocks and bonds moving in the same direction, just like yesterday. So this morning they're moving down as a group. Look for that to decouple. And for the move in the US dollar Japan, keep your eye on US dollar China. It is going to directly connect with energy, but also commodities. I think that pretty much covers it. Everything that I wanted to hit on anyways. If we break our Globex low, we're going to 38. If we break that roundy, 38.11 cog line, then we're going to the roundy 3,800. That'd be a nice play. That'd get your day done right there. I mean, just be done with it, the whole thing. Go eat cookies and come back tomorrow. Everybody be safe, be careful, have a good day. I will see you all tomorrow.